Welcome to this explainer. Okay, today we're looking at something that is totally, completely counterintuitive to basically everything we've ever been taught about money and responsibility. Seriously, we're going to explore why holding on to a massive amount of debt, specifically something like a long-term mortgage, during times when fiat currency is being debased, might actually be one of the absolute greatest financial advantages you can possibly have.
So is your mortgage actually a bet against the US dollar? Now I know, that sounds a little bit conspiratorial, right? We are all so deeply conditioned to think of debt as this massive burden, like a chain around our necks that we just need to throw off as fast as humanly possible. But what if the very system of debt is working entirely differently than we assume? What if taking out a huge loan isn't a burden at all, but rather the ultimate way to short the currency?
All right, Section 1, a bet against the dollar.
Our main goal here today is to completely dismantle that old conventional wisdom. The idea that all debt is bad and that cash is king. We really need to rewire how we view our liabilities by looking at the actual nuts and bolts mechanics of the financial system. Because here's the thing, in an inflationary environment, that traditional safe haven advice just completely falls apart. Think about it. When monetary expansion accelerates, holding cash means your purchasing power is actively, measurably eroding. Your safety net is literally shrinking. But on the flip side, we have to look at the hidden reality of fixed-rate debt in that exact same environment. While the cash holder is actively losing value, the debt holder is experiencing this bizarre, almost magical phenomenon that works heavily in their favor.
Which brings us to Section 2, the math of devaluation.
Let's just look strictly at the mechanical math behind all this. Step 1, you lock in a fixed mortgage payment. Let's say, just for example, it's $2,000 a month for 30 years. That nominal number, it is entirely static. Step 2, inflation occurs over time. We start seeing structural fiat supply expansion and persistent asset price inflation. Basically, the purchasing power of the currency dilutes. Then, step 3, you pay back the debt with dollars that are worth less. I really want you to think deeply about the temporal relationship here. Year after year, that nominal $2,000 you send to the bank takes up a smaller and smaller percentage of your overall inflated income. The payment is static, sure, but the real value of the dollar you're using to pay it, that's shrinking.
The source material actually puts this perfectly. You are paying back debt with dollars that are worth less every single year. Let that realization truly sink in for a second. You are literally paying your lender back with cheaper money. The actual numbers written on the check are exactly the same as they were on day one, but the real-world purchasing power of those numbers has totally evaporated. You borrowed highly valuable, expensive dollars to buy a hard asset, and now you are slowly returning cheap, devalued dollars to the bank over decades. The spread between those two, that is your hidden profit.
Let's zoom out a bit. Section 3, the macro exit strategy. Okay, so if we pull the camera back from a residential mortgage and take a broader macroeconomic perspective, we see that this isn't just some clever personal finance hack. The source material defines this exact mechanism as the systemic exit strategy. Look, we live in a highly indebted world where sovereigns and global institutions are carrying historically unprecedented levels of debt. How do they possibly manage it all? Historically, much like the post-World War II era of financial repression, they don't just pay it off through strict austerity. No, they rely on persistent inflation. By allowing the currency to sustainably devalue over time, they functionally dissolve massive systemic debt burdens. So that math working in your favor on your 30-year fixed loan, it's the exact same math the global economy utilizes on a massive scale just to survive its own balance sheet.
So where does that leave us? Section 4, winners versus losers. If this economic system is fundamentally built to devalue currency as a way to manage debt, we need to look at exactly why understanding this matters for your own wallet. In this system, there is a really stark contrast. On one side, you have the winners, those holding fixed-rate debt. These people are actively, mathematically rewarded by persistent inflation because the real weight of their liabilities is just melting away day by day. And then, on the other side, you have the losers, those holding cash, people playing by the old traditional rules, trying to just save their way to wealth and fiat. They are actively punished by this system because their savings lose purchasing power every single day. The system, by its very design, transfers wealth straight from the cash holder to the debt holder.
So we arrive at this fundamental truth, extracted directly from our source text: inflation acts as a debt solvent. Just like a harsh chemical solvent dissolves paint or rust, inflation literally dissolves the real burden and value of debt over time. It just eats away at the liability until it's just a fraction of what it used to be in real terms. That right there is the hidden structural mechanic of our modern financial era.
Which leaves us with one final kind of provocative question for you to think about. Knowing how this math works now, knowing that inflation isn't just some accident, but rather the planned exit strategy for a high-debt world, are you positioned as a winner or a loser? Are you holding the cash that is actively melting away, or the fixed debt that is being quietly dissolved in your favor? It's a completely different way of looking at your money, isn't it? Take some time to really think about your own financial positioning based on what we've covered today. Thanks so much for joining me for this explainer, and as always, keep questioning the math.